This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And as promised, we're going to talk about the Fed pivot. Taylor, what's going on, man? The yield curve inversion, I think it got as high as 0.82 was the highest I saw. I think it's currently sitting at about 0.7. This is saying that the Fed's going to have to cut. I have many people on my channel saying the Fed's going to cut rates in Q1. I don't see it. I don't believe it. But damn, the bond market does.
Q1, that's quick. That's quick. I don't necessarily think that there's much that could play out that could cause them to revert this thing back downwards in Q1. And that labor print that we just got last week definitely does not say, hey, there's a pivot coming. It says, watch out. We don't necessarily know if inflation is behind us at this point. So I think that to avoid a 1970s type scenario, the last thing the Fed wants to do is say, go ahead and cut rates here in Q1. This thing's behind us. Don't worry. Inflation's taken care of.
Yeah. So the other thing I want to talk about is Wednesday last week, Powell talked and the stock market took off.
Oh, they love that. Yeah.
So in my opinion, he was just about as hawkish as he was in previous meetings. Higher, longer, slower. He did take a victory.
Slower.
Yeah, I don't like slower. I'm a rip the Band-Aids off guy. I hate one hair at a time, but I think we're going to get slower.
Yeah.
So what I think happened last Wednesday, which I did not appreciate until the next day when I thought about it, is what I think Powell did on purpose or not, is I think he took the upper bounds of the Fed funds rate or overnight rate off the table. Because I think Bullard dropped a bomb the week before saying we could have to go to 7, the Taylor rule, blah, 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 7 and then 6. I think what Powell did last week is he said, we're going higher than you expect. We're staying there, but we're not going to 6 or 7. He never said that, but I think that's what came off the table. And I think market doesn't like uncertainty. And that's why I think the 10-year note came down so much, is because these upper bounds came off the table. What do you think about that?
I think you hit the nail on the head. I really do.
Yes.
I think
Woo, I like being right.
No, I really do. I think that he said it's going higher. He said it's going to stay there longer. Two bad things. He did say it was going to get there slower, which the market liked. But at the end of the day, the Bullard's a hawk. Bullard's the hawk of hawks. So he's going to say 7-8%. And actually, and this was commented on in video one a little bit, it's not to say that I don't see any scenario that plays out where Bullard is absolutely incorrect. There is the thought, at least in a small percentage, and I call it only 10 or 15% chance, that we are in this kind of 1970s type inflationary market, that this thing's just taking hold. We can't get it under control, and rates have to continue to go up. Because I do feel, and I think that with a lot of conviction, that the Fed is not going to cut until this is very, very, very clearly behind us. Runaway inflation is a scary thing that the Fed wants nothing to do with. We dealt with in the 70s and the early 80s. They said, we're not going back there. That is goal number one. So when this becomes very clear and very transparent that inflation is behind us, and for the record, I do think peak inflation is behind us. So I do think this will be realized at some point next year, but They will not cut rates until it is ultra apparent to them.
Yeah, when I look at this Fed pivot that the market so desperately wants, and some people think it's happening in Q1 because of bond rates, which I just don't see. I do see my call of the next Fed rate hike still being accurate. I think we get 50 next week, and then I think we get 25 every subsequent meeting. I think it was Bernanke that hit us with like 17 25s in a row. I think all we get after December 14th is 25. So we're tinkering, or whatever freaking little word they want to use. But ultimately, I think terminal rate's 5%.
Yeah, I think that's probably the really good over under. I would take the under on that, but I don't think it's meaningfully under. I mean, we're at 4 right now, so that's only to say that we're going to get 50 and then 25. But it might very well go 50, pause 25. Right? They're saying that they're going to do things more slowly.
Yeah, I think anything's possible, right? We're just two random guys guessing. I don't think Powell would have a pause after a 50. I think he wants to show steps. 75,
descent.
50,
Yep.
25,
And,
right?
and you're right. As I say that aloud, that probably doesn't come off well, because probably what would happen there and not
The
what
market
they
would
want to
race
happen.
higher, right?
Boom, bang, off to the races.
Yeah, we're done.
Yeah,
We're done
yeah.
early.
You see that? It took you
No.
4 words to convince me I was wrong. No, but you're right. It would. The market would digest that poorly probably, and things would be off to the races. And probably what would have to happen would be some really weak data came in order for that to be caused. But I do think they're prepping us
Oh, no, for
for
sure.
that inevitable change that's coming.
I
In
think
the
the
slowdown.
last Fed rate increase, because I think it could go 50, 25. I think to get to 5, I think we have to go 50, 25, 25, 25. Right? Because I think we're
Yeah,
at
we need 100 basis points. We're
we need 100.
375 to 4 right now, so we need 100
so
basis points.
so yeah, so we need 50, 25, 25.
Yep.
So that would be March.
Yep.
I could see that. That's my base case.
That
today.
seems like the most logical. I didn't look at Fed funds rate. Sometimes I do prior to this, the forward rates. I would say without having looked, that's probably the expectation that's baked into the market right now. And if
Yeah.
we get data in one direction or the other, then they have to adjust from there, and the market reacts accordingly. If they have to go higher, the market will react downwards, and vice versa.
Yeah. Yeah, I think that's where we are. So again, I don't see a Fed. And then the last thing I'll say is I don't see the Fed cutting at all next year. I do not see a cut next year. I think the recession that we will have is like 1969 or 70. I think the Fed can tolerate 1% negative GDP. They can tolerate 4.5 or 5% unemployment. And I think that's what 2023 is.
So I'll take the other side of that. I do think we get a cut towards the end of 2023. Historically, what we've seen is when the Fed raises and then stops, about 6 months later, they get a cut. And that's not even necessarily why I'm saying this. I just think that the lag effect of the raises that we've gotten have not fully matriculated into the market, and then it will continue to slow things down at the rate that they're slowing down right now, if not in a accelerated deceleration. Wow. Yikes.
Yeah.
The deceleration will
get
speed
it.
up. Yeah, exactly. So I think you'll see a little bit more of a slowdown. And I do think the Fed will step in and cut. But I will also say this, that with the strength of the labor market that we've seen and the persistent strength of the labor market, my conviction in that thought is getting less and less.
Yeah. So let me put it this way. If next year is a recession but it's a 1969 style sub 1%, is that bad enough to cause the Fed to cut rates?
Probably not. Probably not.
I don't think so
I
either.
think it depends. The duration of it. The duration of it matters. How quickly it moves matters. Rate of change is the biggest thing that matters.
I agree. Rate of
in
change
the economy in general. So I don't have a great answer to that. If it kind of moves down to 0.6, 0.9 negative and then kind of reverts back up, no, it probably doesn't. We probably can keep them where they're at. And would that be the worst thing in the world for the market? I don't think so. No. And I think that you will get a moderation in things like mortgage rates if we get that, because again, mortgage rates are setting off of future expectations that rates continue to go higher. So that ticks back down. If we get moderating GDP or negative GDP, the market's going to go, the Fed might have to cut. If not, they definitely can't continue to go higher from here. And then you get that settle down in mortgage rates and some normalization.
And then banks will collapse the spread, because again, one of the reasons we had is this huge spread because banks were seeing 6, 7 as possible, and all that refi risk that just collapses because the mortgage. It all feels like 2023 is just going to be a year of chilling out, cooling off, and getting back to a better place.
Right? A reset. Like you think about like an NFL team is a rebuilding year. We have to, trade away a bunch of players to get in a bunch of new ones in the draft next year, because we're just going to try to set the base from here. And I think that that's a really good way to think about it. And I think that from an investment standpoint, which is how we look at things as investors, is I think the market's got worse expectations than that. And so with worse expectations than that, I think you do get positive returns in the stock market next year. I'm not saying wildly, so here's an interesting way of looking at things. Consumer confidence is the ultimate contra indicator, right? So it's an inverse indicator. So there's a really good graph that's in the JP Morgan slide. We'll do something on our Instagram thing here soon, because I think this makes sense. But it shows high water marks over the last 8 market cycles. At the high water mark of consumer confidence, The subsequent 12-month period averaged an S&P 4% return, which is meaningfully below. It's about 40%
trend.
of its long-term average, and 50% of the time it was negative. On the inverse of that, we are on the bottom. We are at ultimate pessimism right now when it comes to consumer confidence.
Yes.
I'll let you venture a guess here and it's a big number, I'll tell you. So over those 8 periods where consumer confidence troughed, the subsequent 12-month period, where do you think the market was up?
42%.
Not that much. That's crazy.
Ah,
25%.
Oh, I was gonna guess 20 until you told me it's a big ass number. So I let you anchor me higher.
I know, I did. I gotcha. So, but here's the other stat on that. The worst year ever in that period of trough pessimism over the next 12 months, 14% return. That's the worst. So like, and again, there are things that could throw this
Dude,
off.
I love buying when everybody's scared. I mean, I've been doing that the last 20 years of my life. I'm doing it now. It's awesome.
I was going to say, you're doing it right now. Case in point.
I bought Meta when it was scared. JP Morgan was crazy. I just bought some more Blackstone, buying a second tranche of that. I'm closing on another house tomorrow. Dude, I love buying when everybody's scared. It's awesome.
I love it. I love to hear it because not many people are able to do it. The stomach is tough on investors.
I like standing alone. I hate crowds, at least from an investing standpoint. I freaking hate crowds. All of you crowd people run the wrong way. It's crazy.
That's exactly right. That's exactly
Taylor,
right.
where can people find you?
Yeah, find us on Instagram at Life Goal Investments. So it's at Life Goal Investments.
Do me a favor,
again,
follow him. Let you know you came from one rental at a time. I'd love for him to know that
people have been doing that. People have been doing that. So I appreciate the channel so much. Thank you all for listening. We appreciate you guys.
Awesome. Thanks, buddy.
Thanks, Michael.